Welcome back, everybody. We're still talking about earnings, and today it's two of the most interesting companies in my portfolio, Amazon and Cloudflare, with one of them proving once again that people online speaking with the most confidence usually don't really know what they're talking about. But we'll get into all that. First, though, let's start with Amazon. Now, Amazon is currently my largest overall holding, and it's a stock that I've consistently said is in my top 3 of highest conviction holdings in my portfolio. So let's go ahead and take a look at their earnings. Now, as always, you guys know I like to look at their previous quarter results to take a look at what guidance they provided us last quarter to see how close they came to hitting their own expectations. And Amazon's one of those companies where they clearly outline their financial guidance in their earnings releases, and they use plain numbers and clear language so you can easily understand what it is they're guiding for. And I just want to say that Amazon, thank you for doing that. It makes my life so much easier.
Shut up.
So if we take a look at what they guided for Q4, they expected net sales to be between $181 and $188 billion, which would be about a 7 to 11% growth rate, and operating income expected to be between $16 and $20 billion. So let's take a look at what they actually achieved. So if we look at their fourth quarter results, we see that net sales increased 10% to $187.8 billion. So that's right there at the top of their guidance range that they provided. And then operating income was actually $21.2 billion, which exceeded their guidance by about $1.2 billion. So just on the surface, that's pretty good results in terms of their original guidance that they gave us, but let's continue on. All right, so let's just take a look at a couple other things here. AWS was up 19% in terms of net sales, which is, I think, exactly the growth rate from last quarter as well. And if we look at net income per share, it was $1.86 per diluted share compared to $1 per diluted share a year ago, which means they had earnings per share growth of 86% year over year, which is, amazing growth, especially for a company of Amazon's size. Now, if we take a look at their earnings performance compared to the estimates, we can see that they've pretty handily beat estimates for the past year, and the growth rates have been insane. So even though this line is like decelerating growth, look at the growth rate. So it was like 200%, 93%, 52%. So, these are pretty insane growth rates, 86, which we just talked about. And so even though this is decelerating, it's decelerating estimates to 37%, which is still amazing earnings growth. And then even 12%, which, is a lot lower than it's been, but still it's double-digit earnings growth, right? So, this story for Amazon has been a really good one. And when you just see this, it's clear that they're crushing expectations, and expectations keep going up. So, at some point, this is going to slow down, which is what this line is kind of telling us. But still, it's good growth. All right, so if we take a look at what the market reaction was, on Friday, it was down over 4% on the day for Amazon. And so what's going on there, right? They actually hit their revenue guidance. They were at the top of their range. They exceeded their operating income guidance. Their earnings per share growth is 86% year over year. So what's the deal? Why is it down 4%? Well, I think the answer is in the guidance they gave kind of for the rest of the year and for the next quarter. And so if we take a look at the guidance that they gave, they expect net sales to be between 151 and 155 billion, or to grow between 5 and 9%. So they're guiding for less than double-digit percent growth, which is something that hasn't happened for quite a while with Amazon. And then operating income is expected to be between 14 and 18 billion, compared with the 15.3 billion in the first quarter of 2024. So their operating income range is between 14 and 18 billion, which if it comes in at 14, it means that it's actually less than it was a year ago. And then in their conference call, they said that the 26.3 billion that they spent on CapEx in Q4 was about what they expect the run rate to be for 2025, which if I do some quick math equals over $100 billion in CapEx for Amazon in the next year.
Hang on. I'm just checking your math on that. Yes. I got the same thing.
And if we actually take a look at their investor presentation, we can see a little bit more. Now, if we scroll down here to operating income trailing 12 months, you can see, this has been just an amazing story for Amazon over the past year or two. And then if we come down to AWS, it's a similar story. Net sales are still up. That's great. Operating income from AWS is up big year over year, which is awesome as well. But then if we take a look at the free cash flow slide, what we can see is that Amazon's been on a great trajectory as it relates to free cash flow growth over the past year or so. But with this quarter, it's actually just slight growth of 4% year over year. And when you combine that with the fact that they're planning to spend $100 billion in CapEx over the next year, then you can see why people are getting a little worried about it. So that being said, what are my overall thoughts on Amazon? So I think what we're seeing with Amazon here is kind of like what we saw with Google, where they had a really good quarter, but then the stock sold off because people are worried about what's happening in the future. Now, Amazon's a company that I've been talking about for about a year now, and in that year, it's up around 34%. And if you go back over the past 2 years, Amazon's up over 160%, and their business has been on a tear of profitability over that last 2 years as well. So I think what you're likely seeing is just people that are taking profits on a company that's had an amazing 2-year run, but now expects to see a little bit slower growth going forward, because they've already told us they're going to be investing a lot into CapEx, but also their comps now are comps from 2024, which was a banner year. So it's going to make it a little bit tougher to beat and have those great growth rates. So the question is, well, is that a bad thing? Should we be selling Amazon now because of that? And the answer is that it really depends on what your goals are. Because to me, Amazon is still one of the best companies in the world. Yes, their overall growth may be slower than last year. Their CapEx investments may eat away at their earnings and or cash flow more than they have in the past, but all the same things that I liked about Amazon are true today as they were a year ago. And I think this is a big thing we don't talk about enough as investors. Like, if a bunch of people on Wall Street or hedge funds are selling Amazon, does that mean that we should be selling it too? And the way that I would answer that is with a question. Like, well, what's their investment timeline compared to what's your timeline? Do you have the same goals and risk tolerance as they do? I mean, just following someone else's trades doesn't make sense when you don't know what their goals or timeline is. And this is something that I think a lot of people struggle with. Because look, stocks don't just go up in a straight line. They go up and then down. They have various business cycles that change and evolve. Now, if your strategy is to be a more active trader, get in and out of positions once they reach a peak, then by all means, do what you have to do. But to me, Amazon and big tech more broadly are still some of the strongest companies in the whole market. And they're still going to be delivering strong earnings, even though the growth rate may be slower than what we've seen over the last couple of years. So to me, over the long term, that still equates to success. So in my opinion, Amazon's still a great company. I have no plans to sell. I'm holding my position and we'll see what happens. Okay, but now talking about stocks that apparently do go up in a straight line, let's talk about Cloudflare. Now, if we look at the guidance they gave us last quarter, they said they expected total revenue to be between $451 million and $452 million, income from operations to be between $57 and $58 million, and non-GAAP net income per share to be 18 cents. Now, if we look at what they actually reported, we see that fourth quarter revenue was $459.9 million, which exceeded their original guidance and a 27% year-over-year growth rate. Their non-GAAP income from operations was $67.2 million, which was a significant beat from their own estimates. And their non-GAAP net income per diluted share was 19 cents, again exceeding their estimate of 18 cents. And then if we take a look at what they guided for next quarter, we can see that for Q1, they expect total revenue to be $468 to $469 million, which would be about a 24% increase year over year. Their non-GAAP income from operations they expect to be between $54 and $55 million, which would be about a 30% increase year over year. And then lastly, net income per share to be about 16 cents, which would actually be flat year over year, which is kind of interesting. And then just real quick, if we look at the full year, they expect total revenue to be between $2.09 billion to $2.094 billion. I honestly don't know why Cloudflare tries to be so precise with these. I actually think they could open up that range a little bit to give themselves a little bit of wiggle room, but it's just kind of strange like how close together those numbers are. But anyway, if they hit this, it would be about a 25% increase over what they made in 2024. Non-GAAP income from operations between $272 and $276 million, which would be about a 20% increase over 2024. And then lastly, non-GAAP net income per share between 79 to 80 cents, which would only be a 7% increase from what they did in 2024. So if we just take a look at their earnings history compared to estimates, they've had a pretty good history of beating analyst estimates, which I guess is good. I mean, the estimates here are going up in terms of Q1 to Q4. So it's just kind of strange that they expect earnings per share for 2025 to only be about a 7% increase. Now, what could happen is if they come in way higher like they have over the past, I don't know, few quarters here, then it could be way higher than 7%. But right now they're guiding for 7%. And I just think that's kind of interesting. Now, in terms of how the market reacted, well, the market loved it, sending Cloudflare up over 17% on Friday. And at one point, it was up over 20% intraday. And you might be wondering why, when you see these kind of basic stats and fundamentals here in their earnings, it didn't really look all that great. But I think there's a lot more good news if you look a little bit deeper in their supplemental report. And if we take a look at their key business metrics, what you see is that paying customers is something that's actually been accelerating, with the growth being 25% in Q4. Now, if you remember, paying customers for Cloudflare is important because their customer acquisition model is that they offer a lot of stuff for free. And the idea is that they get people in, use their great services for free, and then they try to convert them to paying customers. So paying customer growth accelerating is good. And then paying customers that are more than $100,000 in annualized revenue has also been pretty good at 27% growth for the quarter. And their dollar-based net retention rate had been going down for 3 straight quarters, but it inched up slightly in Q4, which is pretty good. But then lastly, their remaining performance obligations, or RPO, which is basically future revenue that they expect to receive from signed agreements, was actually up 35% year over year and 12% quarter over quarter, with 70% of that expected in the next 12 months, because that's what it means when it says current RPO. So what are my actual thoughts on this? Now, I think there's a couple things that are going on here. Overall, I thought that Cloudflare's earnings report was good. I mean, it's obviously a business that's growing because they're in the high 20s in terms of revenue growth. They're in an industry that's growing like crazy. And we haven't even talked about edge computing, which is where I personally think they're very interesting long term. But the question people will have is, but the valuation is so crazy and it just keeps on going up. And look, on some level, I definitely agree. But remember what we talked about last time. Like, not everybody looks at fundamentals when it comes to buying stocks. People trade on momentum and charts and future prospects as well. And I think what you're seeing with Cloudflare is a combination of these things. They're in a strong secular trend of cybersecurity, cloud, and eventually edge computing. They're a software company as people are looking to move money out of the AI hardware trade, out of the Mag 7 to smaller cap software stocks. Plus, as more people have talked about AI agents and inference workloads, Cloudflare's strengths are coming into play, which they talked about on the call saying, and finally, I think that inference and agents are the really big opportunities in AI. And while a lot of the money that's been spent has been spent on training for the last little bit, I think as we go forward, a lot more of that money is going to be spent on inference and agents. And again, the killer application for Cloudflare workers is inference, it's agents. And we're seeing more and more companies that are running with exactly that. And so this is the beginning of what I personally thought was their most interesting opportunity. So when you put all those things together, you can understand why it might have been going up so much. But here's the thing for me. I added Cloudflare back in August when it didn't seem like many people were talking about them. I like their products, I like their customer acquisition strategy, I like their potential in edge computing, and I wanted a smaller cap tech company in my portfolio to balance out all the mega cap tech that I already had. And we talked about all this stuff back in August, and it just happened to play out really well over the last 6 months. Plus, it had a pretty good technical setup at the time, so it was a bet that I thought was worth making, and it's turned out really great so far. But I will say this, on Friday, I ended up selling half of my Cloudflare position. I still have 100 shares of it that I'm going to let play out because, again, my long-term thesis for the company is still there. We haven't even really got to all the edge computing stuff, all the AI inference stuff, but the way I looked at it is like this. I have an investment that went up basically 2x in 6 months, and it's trading at valuations that are just kind of silly right now, right? And so my view on that is it's a gift, right? Those things happen from time to time. When they happen, I think we're very fortunate, and we should consider kind of taking some profits off the table because at the end of the day, we're doing this to make money. Right? So by selling half of my position, I basically recoup my original investment back, and now I can put that money into something else as I let the other half of my Cloudflare investment just continue to go until the business story changes. Now, I will say I actually sold at the open on Friday, so it's even gone up a lot more since I sold, and that's okay because basically doubling my money in 6 months is a huge win. And I'm still invested in the company, so I'll continue to see where they're going with just a little bit more money in my pocket that I can invest in something else with, which, spoiler alert, I'm going to be looking for something, again, similar to Cloudflare to put that money into. Which brings me to my last point. Now, you may or may not remember, but about 6 months ago when I added Cloudflare to my portfolio, I got a lot of comments just like these. Be cautious with this one. I think it's not going to end well. I don't see much in this video that makes me think this stock will outperform. Their stock-based compensation is rising faster than their revenues. That's a huge red flag. Are they even the rightful winner in the space they compete in? Do they have a moat? And again, it's just to show you that people assume that stocks only move up and down based on fundamentals, and that's simply not true. So when they say things like, but this company has no moat, they have too much stock-based comp, stocks can go up and down for many different reasons, and fundamentals is simply one of them. So my point is there was more than a handful of people talking about how Cloudflare was going to be a bad decision, and yet it doubled within 6 months. And that's not to say, oh, look, I'm right and they were wrong, because you guys know that I've been wrong about a lot of stocks on this channel. But what's important about this is that you have to be able to make decisions based on your own personal strategy and what you believe makes sense for you, and just not worry about what anyone else thinks about it. Because there's always going to be people who are willing to tell you how stupid you are about something, but it's your money and not theirs. So have your plan, work your plan, be consistent with it, and just understand that every decision you make may not work out. But stop worrying about what other people think about it, because they probably don't know anyway. Now, if you missed my original analysis on Cloudflare and you want to see that, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins, and I'll see you on the next one. Peace.